Welcome. Today, we're going to dive into a really fascinating case study, Ethiopia's tax system. It's this incredible puzzle where the simple goal of making taxes easy actually ended up creating a complicated maze. It's a perfect story of good intentions and, well, some very unexpected results.
Okay, so to get our heads around this, let's start with a really simple idea. Just imagine for a second that instead of lumping all your income together on one big tax return, it gets sorted into four totally separate buckets. You'd have one for your salary, another for any rent you collect, a third for business profits, and maybe a fourth for everything else, like royalties or if you get lucky and win the lottery. And here's the crucial part. Each bucket is its own little world, taxed completely on its own.
So that brings us to the big question, right? On the surface, that sounds pretty simple. You just figure out which bucket your money goes in. But what happens when real life gets messy? When things don't fit so neatly into these little boxes. Does this system actually make things simpler and fairer, or does it just open up a whole new can of worms?
Well, this four buckets approach actually has an official name. It's called a scheduler tax system. Now, this is totally different from a global system, which is what many of us might be used to, where you just add everything up into one big pile. Here, each category, or schedule, is treated like its own separate universe, with its own rules, its own rates, and even its own tax return. So let's see how this actually plays out in the real world.
All right, first up, let's look at a situation that causes a ton of confusion. That super blurry line between being a salaried employee versus being an independent contractor. It might not sound like a big deal, but in this system, that distinction changes everything.
Let's make this real with an example straight from the research. So, picture a university professor. She gets her monthly salary. That's easy, right? That's clearly employment income. But then, what happens when that very same university pays her an extra fee to write a new textbook? Is that still just part of her job, or is that now a separate business deal?
And the answer to that question has massive financial consequences. Look, if that textbook money is considered employment income, it just gets piled on top of her salary and taxed at her highest rate, which can be up to 35%, and she gets almost no deductions. But if it's classified as business income, it goes into a whole other bucket. It's taxed separately, and she can deduct her expenses, like for a computer or books. So think about that. Same person doing work for the same employer could end up with two wildly different tax bills.
And this kind of complexity doesn't just stop with individuals. Oh no, it gets even more tangled when we look at what seems like a pretty straightforward business, like real estate.
So, picture this. You've got a single real estate company. They build and sell houses, and they also keep a few properties to rent out. In most tax systems around the world, that's just one business. All the money it makes is just business income. But not in a scheduler system. Here, where the money came from is everything.
And what you get is a bureaucratic headache. The money from rentals goes into one bucket, Schedule B. The income from selling the houses, that goes into a completely different bucket, Schedule C. This means one company is forced to basically operate as two different businesses in the eyes of the tax authority. They have to keep two sets of books, file two separate tax returns. It's double the work. And here's the real kicker. If they lose money on rentals one year but make a profit on sales, they can't use that loss to offset the profit. It's a huge disadvantage.
Okay, so we've seen the buckets for work, for business, and for rent. Let's look at the fourth one, Schedule D. This is the everything else category. And this is where the rules get really, really strange.
Just take a look at the tax rates within this one bucket. They are all over the place. These are flat taxes, which is simple, but the rates themselves are wildly different. If you earn royalties, you're taxed at 5%. But if you provide technical services, that's 10%. And if you win the lottery, that's 15%.
You can probably see what this does, right? It creates a huge incentive to play a labeling game. I mean, if you're a consultant, would you rather say you're providing a technical service and pay a 10% tax? Or would you say you're licensing your intellectual property and receiving a royalty for only a 5% tax? The actual work could be identical, but calling it one thing instead of the other literally cuts your tax bill in half. The system itself is pushing taxpayers to find the loophole.
So let's take a step back from all of these examples, because a pretty clear pattern is starting to show up. What's the ultimate price you pay for this kind of simplicity?
And this, right here, is the central paradox of the whole thing. The system was designed to be simple. Find the source of the income, put it in the right bucket, apply the rule. Easy. But life, as we know, is messy. So the complexity didn't just disappear. It just got moved to the edges, to the boundaries, between the buckets.
And that's where you find all the ambiguity, the administrative headaches, and let's be honest, the unfairness.
And these aren't just theoretical problems. They have very real-world consequences. You get people doing almost identical work, paying totally different amounts of tax. You have businesses spending more time and money just trying to figure out their taxes. The system actively encourages people to find clever ways to relabel their income to pay less. And it can seriously punish businesses by not letting them offset their losses against their gains.
You know, this tension is nothing new. Way back, the famous economist Adam Smith argued that having certainty in a tax system was actually more important than having perfect equality. He figured that people just need to know clearly and simply what the rules are and what they owe. And you can kind of see how Ethiopia's system, with its separate schedules, was probably aiming for that kind of certainty.
But as we've just seen, that quest for simplicity can create its own kind of deep uncertainty and inequality. And that leaves us with a really fundamental question. What's the right trade-off here? Is a system that aims for simplicity but ends up being unfair really better than a more complex system that at least drives for true equity? There's really no easy answer, is there?